Hello, everyone. Thanks for joining us once again here on CBS News. I'm Lana Zak.
And I'm Errol Barnett. We're approaching 2 p.m. here on the East Coast. And at this moment, the Federal Reserve is expected to hold its benchmark interest rate steady.
Now, if that is, in fact, what the Fed decides, the decision would keep rates at a 22-year high through the start of 2024. Now, this would be the third session in a row in which rates would stay where they are. The Fed has announced 5 rate hikes over the past year and 11 since they first began their inflation control measures back in March of 2022.
That's right. Jill Schlesinger and J.D. Durkin join us now. They're ready to join the conversation. Jill, as you well know, is a CBS News business analyst. J.D. is a CBS News contributor, newly minted, by the way. Congratulations, J.D. And he's a host for the financial news website, The Street. Great to have you both with us at this moment. Jill, let's start with you. As we've been saying, the Fed is expected to hold rates steady. Just flesh out for us why that is.
Well, inflation has come down, and that is a very good sign, but they're not going to cut rates until inflation comes down to their target. So we had a CPI report out this week, showed that there's inflation running at a 3.1% annualized pace. That's the headline. When we pull out food and energy, we look at a core rate, and that's a 4% increase from a year ago. The Fed really wants to see that core rate at about 4%. And even when we look at their preferred measure of inflation, something called the PCE index, say that at your holiday party, that index is showing progress, but not at the Fed's target yet. So they're going to hold rates until they feel like many more components are moving lower.
We don't expect really any surprises coming out of today's meeting. J.D., you are there on Wall Street. What's the mood? How much are they looking at today's announcement?
Well, first, I got to say, talking PCE inflation data is personally my favorite holiday party topic to talk about. I'm sure Jill is much like me there. But it was a really fascinating day with the markets today because I don't frequently look up at what we call the big board here on the floor of the New York Stock Exchange and see the Dow Jones Industrial Average and the S&P 500 both trading up 0.01%. That is fractionally. That's essentially the market's not moving, being at a total standstill. That despite the fact that we did get new inflation data earlier today. We got new inflation data yesterday that we know members of the Federal Open Markets Committee are taking into close consideration.
We see stocks are actually jumping right now. Sorry, JD. It looks like stocks are jumping right now because we just got news from the Fed that they are, in fact, going to do what we all predicted, leave that interest rate unchanged right now. Jill, is that a good decision for the economy?
I mean, look, the Federal Reserve is in a very strange place. And I'm just going to say contextually, remember, the Fed kept interest rates at 0% for essentially a decade before COVID. Then we have COVID. Then inflation starts to bubble up as we come out of COVID. And the Fed is late in raising interest rates. So if we say, is this good or bad for the economy? It's largely expected. Here's the good news about the economy. Even though the Fed has jammed up interest rates to catch up to where they should have been, you know what's amazing? The economy did not roll over. We didn't get a recession. Yeah. We are still growing. And most importantly, the labor market remains very good. It's a solid labor market. So if inflation comes down and the labor market does not roll over, I think that 2024 could be another year where we hopefully escape a recession. But again, we don't know. I think that what the good news is that we're at the end of this rate hike cycle. Rates will come down eventually. I don't know when, but I think we should all be somewhat pleased that somehow or other, even though the Fed screwed this up a lot of different ways, no recession this year.
And we were just looking at some of those indicators of how strong the economy is. Some 200,000 jobs added in November. We'll see what December looks like, but it's really the employment sector has been healthy. Unemployment rates have stayed low. JD, as Lana mentioned, as soon as the news was official that the Fed leaves interest rates unchanged, saw a bit of a spike in green where you are. Talk to us more about the expectation compared to the reality for Wall Street right now.
Well, I would like to caution viewers that, it happens frequently on a day like today is what technicians are fond of saying. The first move might end up being the wrong move. And what that means is we get so many pieces of data. It's not just the top line print from the Federal Reserve, but then we have the question and answer portion of the press conference, which we'll get from Chairman Powell in about a half hour. But here's what I suspect might be moving markets just in the last few minutes. We get what's called the Summary of Economic Projection. In other words, the dot plot. It's an anonymous survey from the Fed. Hey, voting Fed officials, where do you think unemployment is going to go? Where do you think GDP is going to go next year? Where do you think interest rates will go next year and over the course of the next few years? We only get 4 of these a year. We get 8 Fed meetings. Every other meeting we get a dot plot. Today was a dot plot day. And comparing the dot plot notes from the Fed from September, the last time we got a dot plot, but to today, that no longer appears as if the higher for longer rhetoric, that narrative is continuing. Voting officials of the Fed, according to their median estimates, are telling us that by the end of 2024, they see the federal funds rate coming down to 4.6%. 2 months ago, they saw it up at 5.1%. If there's anything in these early indicators that I think could give investors writ large a bit of confidence that the easing of interest rates is continuing, like Jill just said, it's likely some of these numbers in the Summary of Economic Projections. But again, I caution, it's going to be a long next 2 hours or so with lots of little data points and, of course, comments from Chairman Jerome Powell to comb through.
Yeah, that will be what we will all be hanging on, especially markets, Jill. Based on what JD just said, I mean, yeah, yesterday's consumer price index shows that inflation is cooling. Perhaps the Fed wants it quicker and faster. But are we getting signals and signs now then perhaps rate cuts are in our future in 2024? Any leading indicators there?
First of all, the Fed has been wrong on all of their dot plots for like 2.5 years. Just
really?
like you and I would be wrong. And just like we get a bunch of economists together and they've been wrong. So this economy has defied expectations. And I also want to be clear that as we talk about inflation cooling, we also have to recognize the reality of what we all know, which is things feel like they are more expensive. And that sticks in our inner being. It just does. And if you think about it, I looked this up after the inflation data came out. If you look at what you could buy for $100 just in 2019, it cost $120 to buy the same amount of stuff in this year as it did for the $100 in 2019. That $20 difference is what people are freaking out about, and that's what they are thinking about. So that kind of explains that the economy appears to be doing well. However, people feel rotten. And in many respects, it's not just people who have piled on debt. Of course, they're going to feel rotten, but people feel the impact of inflation for a longer period of time. I would not put any credence in what the Fed believes the next rate hikes or cuts are going to be. Their own dot plots have been off. And I think what's most important, if you are watching out there, is how does this all impact you? If I'm a borrower, rates are staying high. It costs money to borrow. And if you go out there and you're looking for a mortgage and you're getting a new car and you've got a credit card balance, it's expensive. However, if you are a saver, if you hear the shouting and the glee around anyone, that is the saver who said, for 10 years, I got paid 0% interest. I can now get 5% on a high yield savings, on a money market account, on certificates of deposit. So that's the divide that we're seeing. If you have money, you're making more money. If you have to borrow money, it costs a lot still.
And the Fed wants it to be painful for people. They want us to pull back on how much we're spending to help bring down those inflation costs. And part of the reason why people feel like things are more expensive is because they are. Even if the rate of inflation is slowing.
Absolutely.
Inflation has already happened, and so the price is still really high. And I think that that's something that it's difficult sometimes for people.
I mean, think about this. Housing prices are 40% higher than they were before COVID hit. That is an extraordinary movement of an asset class that does not usually move like that.
Absolutely. JD, bring you into this conversation. To what extent could the producer price index report play a factor into all of this? Obviously, if things are more expensive in the inputs, they're going to be more expensive in the outputs. Talk to us about how all of that is happening.
Well, we did get that read earlier today. It was for whatever bit of good news that it could be perceived to be, to Jill's last point, the second lowest reading in a year. And this largely describes to us what businesses are paying to suppliers. So it's one of the gauges of inflation, not necessarily the one that the central bank most directly looks at. But you got to think over the course of the last month or so, we have seen a pretty significant decline in oil prices, not nearly where they were pre-pandemic. If you're driving around in your neighborhood, you likely will have noticed the last 4 to 6 weeks or so, hey, that was a bit more expensive at least a month ago, and now those prices are coming down, still very far off in terms of the overall progress. But some of the indicators we follow are things like West Texas Intermediate and Brent crude. This is domestic and global oil benchmarks as well. Back in October, we saw those numbers up around $90. We're now seeing them near the high 60s to low 70s. So arguably, I would argue the producer price index figure today did not really move the markets a whole lot. I think we were in wait and see mode in terms of what the Fed had to do, but I really can't underscore a lot of Jill's points. Let's be honest, does the average consumer, the average spender, the average viewer of this segment right now necessarily care what the nuances of producer price index or PCE data are? No. They likely put much more of an emphasis to say my rent is more expensive, my food is more expensive, and my gas has been more expensive. And especially as we turn the page into a presidential election year, it's going to be all well and good for different economists, for the Fed, maybe even for the Biden White House to point to signs of slowing inflation. But if that does not match the day-to-day reality of the actual voters or the spenders in the economy, those two things simply won't match up. And I think that's something for economists, for the Fed, and for the White House they'll have to contend with for the better part of the next year.
It's a solid point to end on. I don't know what you're worried about. I would happily be cornered by you both at my holiday get-together. Jill Schlesinger and JD Durkin talking CPI, PPI, and dot plots. Great to have you with us today. We appreciate it.